is where we are at. Jitendra Gohil is with us, Chief Investment Strategist at Kotak Alternate Managers. Jitendra, good to have you with us here. Thank you for your time. In terms of variables that you are watching, which will determine direction for markets from here, Jitendra, what are the top 2 or 3 things? There's of course earnings, there is a selling from FIIs, but you also got this very strong trend now developing in the US dollar, which is putting pressure, of course, on Asia forex, rupee, CNY, etc. How big a factor is that? And just, to your mind, what are going to be the dominating drivers, and what's the view which is forming at your end? Are we close to some sort of a trough? We've broken 24,000 by about 50 points or so today, this afternoon, or there is more to go?
Hey Prashant, hi. Thank you for inviting me on your show. There are several questions, so let me just quickly, answer and put some perspective about what we think about the Indian equity market. So markets are generally driven by valuations and earnings. So obviously, you mentioned the earnings cut is a bigger worry in my view. I think what we have seen for FY26, the earnings growth is still a little bit optimistic. It might come down further. So in that view, I think market will remain a little bit subdued from earnings perspective. However, valuation is pretty challenging subject. I would say that, look, the bigger challenge for India is stronger dollar and how Donald Trump's policies are going to spark inflationary worries in US. So what we're hearing is like, look, if Mr. Donald Trump goes for higher tariffs on imports and also give a lot of incentive for corporates to invest back in US, that will lead to significant inflationary pressure in future. Now, 2 ways to look at it. If there is inflationary pressure in US, then definitely there is some offsetting factors that should be on play. Otherwise, inflation will run out of hand, and that will lead to significant trouble for the economy. So one way the Trump government can control inflation is by cutting budgets. So probably the fiscal deficit, which is running in US at around 6-7%, will have to come down because the debt to GDP in US is around 125%, and every 100 days we hear that the debt level in US is going up by $1 trillion, and today the interest cost to service that debt is around $1 trillion per annum. So I think US actually is in a difficult spot as of now, that they have to control inflation, they have to control interest rates and the kind of problems that they are facing on the debt side. So one way to do it is to cut budgets. So probably government jobs will be cut in US, or we might see the commodity prices, right? So if you're not able to control inflation domestic, what you do is try to control the commodity prices, and hence, I think Donald Trump's policies is also to mine more infuse mining activities, also drill more oil, sanction or put more tariffs on China so that the global inflation comes down. So I think there will be a kind of a confluence of factors which is going to impact the equity markets globally. However, one thing one has to understand in this kind of scenario, we are not alone. If you look at the global as a one market, if US does not do well, even our economy, Chinese economy does not do well. And the other way around, if the global market does not do well, even US will not do well. So tariffs, I think, should be measured, but I think market is now taking a cue that, look, there will be a tariff war, and hence I think market is a little bit, sentimentally taken a backseat. One has to observe how things pan out. From India perspective, I feel that the impact on Indian market will be limited, or I would say that the relation between US and India was actually very good during Trump presidency. And now again, when Mr. Trump is back as a president, I expect that both the countries will find some solution. So there's talks of FTA, free trade agreement with US is ongoing. I don't see that get signed so soon, but certainly there are some industries might see some kind of incentives. So India will have to definitely open up. It will be a transactional relations. So certain sectors which are going to compete directly with US companies in future. I think one has to look at what policies US is making. So net, I feel that market is corrected 9% and earnings cut is almost in that level. So as of now, we haven't seen valuation correction. So in my view, I think once the interest rate starts moving up in US because of inflation worries, there could be more pressure going ahead. Hence, one should remain a little bit cautious in the near term. However, we think that government spending is going to go higher in the next 3 to 6 months, and hence we think that the earnings growth may start to come back. Hence, we are a little bit optimistic from a medium-term perspective.
All right. Hi, Jitendra. Good afternoon and good to see you. And just request you to stay with us. Sambandara Madison, the numbers are flashing you on the screen. On the top line, there's a small miss. The margins as well have come sub that 9% odd mark, which is lower than what we're working with. And that's further percolated down to the net profit numbers. So the initial look at the numbers on Sambandara Madison, it goes down as a bit of a miss. We'll try to get more clarity on this front. Well, Jitendra, how you are placed on autos? You had Bajaj Auto. After a while, it got, disappointed. We had Mr. Rajiv Bajaj try and clarify things. And from Maruti as well, you have a mixed outlook that's coming in there. How are you all approaching this space? Because, there is a bit of a slowdown that we're talking about domestically. The international market as well is in a bit of a tizzy. And there are various pockets where we're seeing supply side issues that still exist. So your approach?
Hey, Nigel. Hi.
Hey.
Yeah, we spoke last time about auto and we said that one should cut exposure and sell auto companies. We still maintain that view. We think that large part of inventory built up ahead of the festive season is over. Now it's the time that the retail inventory should get cleared up. And we think consumption overall has been a little weaker than expected. Hence, I think there could be more pain in the auto sector because the kind of growth that these companies have delivered, as well as the consumption weakness, I think the base is high. We should see more correction in our view, and hence we are staying away from the auto sector to some extent, even the auto ancillary companies. Except in this space, we like that CV space, CV financiers could do well in Q4. Generally, in the March quarter, we see that CV cycle sees some kind of uptick. I think December to March quarter could be better for CV relatively compared to other auto companies, and hence we are buying some of the NBFCs which are financing CV space. Otherwise, we think that the sector is going to see more valuation correction as the earnings are not going to be delivered to the extent market is forecasting.
Jitendra, hi. Good to have you on the show. So I guess the problem with our market is that different pockets have been hit by different issues all at the same time, right? BFSI, the RBI has been talking tough, whether it's unsecured loans, credit deposit ratio, gold financing. So that's where the slowdown is coming in. Export-facing sectors like IT, they have enough on their plate with the US election, etc. And then you have the domestic consumption story, which is under a bit of a question mark as well now, right? So just let's focus on earnings. And you spoke about this 9% drop. Now, earnings have started faltering even before any adverse tariff action comes in from large countries like US or China, etc. What have you made of the earnings slowdown? And you said that the valuations still haven't corrected as much. So how much lower for this market then before valuations get attractive?
So Surabhi, there are a couple of things that we have to take into account. One is the structural growth story for India, right? So that remains intact. In fact, we have been writing that, look, market is going to see pleasant surprise in coming years that India's structural growth story has actually strengthened, and we maintain that view. This is a macro blip for a quarter or two. We think that this is primarily because the government was supposed to spend 17% higher on a year-on-year basis on capex. Year to date, they have actually spent negative 15%. That is, there's a drop in government spending. So such a massive cut in government spending is actually perplexing. And I think you can give reasons because of elections and monsoon and so on. But I feel that, look, this is a blip driven by a massive cut in government spending, both on capex as well as on the revenue side. But once the Maharashtra elections are over, we think that the real estate activities will pick up, which is a major contributor to economic growth. Plus, the government spending can go higher. And hence, we think, again, those stocks which are backed by government spending will start to see some uptick. Right? So we think in the next 6 months, the government spending will accelerate. Monsoon was was better, and hence the reservoir levels are good. I think it is higher by around 13%. So the Rabi crop season expected to be better. The food inflation will come under control, and at least in Q4, the couple of months it may spike, but in Q4 we expect that because of better Rabi crop outlook, the inflation is also going to come down. So in that perspective, we think that we have already achieved or already gone through the tough period from an economic growth perspective. And at the later part of the festive season, we have seen it pick up in sales and economic activity. So net, those sectors which are exposed to government spending will start to come back. Look at the defense. Some of the defense companies which have written phenomenal margins. Obviously, we don't recommend that because of higher valuation, but from operational perspective, these companies have reported decent numbers. Look at some of the hotel companies, right? In the next 3 to 6 months, the outlook is very bright. I think that segment is looking pretty attractive at this point of time. So I would say even PSUs, some of the PSUs have come out with a very strong number, even better than some of the private banks. So I think some part of the sector which has corrected and they have delivered better earnings growth. I think that pocket is looking a little attractive. Now, to come to your question, where the overall outlook or overall valuation will stop, I think, we are trading somewhere around 20-21 times P ratio. India's average, before COVID, because COVID had led to some significant spike. If I average it 10 years before COVID, somewhere we were at around 17 times P ratio. So we are 3 points or 4 points higher. I think if I look at the ROEs, which have almost 8-9% to almost 14-15%, debt to EBITDA was around 3x pre-COVID. Today it is less than 1 times. Our current account deficit was around 2%, and as we speak, we are below 1%, and even will go down or much faster consolidation there. And fiscal side, we all know that we have been continuously surprising on the upside. So from a macro stability perspective, rupee has been extremely stable despite it is touching all-time low. So I think all these things says that, look, valuation is not going to correct significantly from here. It is the earnings-led correction once, and also the flows. I think FPIs are actually a little bit nervous because dollar is strengthening. Once that abates and how much they can sell, some sooner or later there will be a fatigue in selling Indian equity. It's already reached to around 16% of BSE 500, which is 13-year low. So I feel that large part of FPI investments, which are active, FPIs have seen sell off. Probably another, couple of months we see this kind of problems. But then I think we should look at stability in the market, and then from there onwards, the earnings will have to catch up as the economic momentum will pick up.
Got it. All right, Jitendra, we'll leave it on that note. Thank you very much for joining in, and you have a good rest of the day. Need to take a very quick break on that.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.